Okay, everyone. Today is January 31st, 2014. It's last day of the first month of the year. And January have been a quite interesting year so far. Interesting month so far. And as you already heard, if you haven't been, went to sleep or anything like that, all these, talking head is talking about how this January effect and that sort of thing will most likely point to a down year and so forth and so forth because of the past historical, correlation of somewhere around 70 some odd percent. That kind of stuff. My question is that, what about those 20 some odd percent? Couldn't that also occur? You know, why would it be that it won't occur? Those 20 some odd percent here that it's just not going to happen based on that correlation. We are talking about probability. So a lot of these people is talking about almost like certainty that it's going to happen that way. So that's why we always just trade price, right? And even though, let's say for example, 2014 is going to end up to be a down year or something like that, along the way there's going to be some rally and there's going to be some sell-off. So as a trader, what you're just going to concentrate on the short side because of the market is going projected to end the year on a low end or something like that. Well, if that's what your mindset is, then more power to you. But as a trader, you also have to be flexible, and there's always stock that goes up and stock go down, regardless if the market is a bull market or a bear market. So to me, it's a interesting discussion purely for interest, just a discussion purposes. But that's nothing to my trading or anything like that, because you really have to look at, price action. Right, we trade based on price action, and also the other things I noticed there is so many these garbage, nonsense stuff out on the media and on the web. That's why, even some of the stuff that I put on and the chart or the video, I advise everybody do their own due diligence. That doesn't necessarily what I say or what other people say make a lot of sense to you or it is applicable to you. Right? If you don't understand, then either go and ask the question and clarify it, or just ignore it because don't use something that you don't understand. And if something doesn't look right and doesn't make sense, don't bother to try to make sense out of them because there are people out there with their bias that they're gonna draw these lines and draw these Fibonacci retracement and try to make their point. To it's basically they are trying to get these technical analysis to suit their bias. Right? It's absolutely ridiculous to me. As a trader, we have to have an open mind to look at whatever the market tells us how we should proceed. I see something today that's totally blew my mind. I can't even understand, can't even conceive how one would draw a Fib line like that. Fibonacci, and then make these correlation. I said, Jesus Christ, where in the hell did this guy get these things? I don't want to name names, but I just want to point that out. And no matter, and there's people, drawing all these different funny patterns, based on connecting 2 points. You could connect any 2 point to make any pattern you want, right? So it's just ridiculous to me when people try to draw a conclusion based on so little bit of a data, right? Now, hey, if it worked for them, that's fine, right? I'm just saying that there's a lot of stuff out there that might be, valid, and there might be a lot of BS. That's what I'm basically saying. So take what it's worth. Take it as what it's worth, and interpret it the way that if it suits your purpose, fine, but have an open mind. Don't just take whatever other people say. It doesn't matter if the guy got that three little letter and say on under his name to say such and such. Those doesn't mean anything. Just because the guy went to college, got a PhD, doesn't mean he's an intelligent person. Okay, right? It's just that he got the credential. He went through the process. Right? So if those guys saying that such and such, or with these, three little letters, doesn't mean anything, right? Okay, because you know, experience and knowledge doesn't come with letters or getting a certificate. Okay, it's the practice, the hard knock. Okay, the trenches, the guy that has actually went into the trenches and learned how to apply whatever he know. So with this, anyway, I finished with my rant. Hey, shout out to all those people out there that are celebrating Chinese New Year. Happy Chinese New Year. Okay. With that said, let's go and take a look at the S&P 500. We see the S&P 500. You see, let me take out this flip knife first, and then we put it back on here. You can see that we came down and found some low support here, somewhere around this close to this 1770 level here. We got a little bounce. Right now, we get a little consolidation here, but you notice that some of these, moving average kind of turning down. So it kind of tell you that we're going to have a little period of consolidation before it actually go back up if we decide to go back up and take out the previous high. Or if we're going to go down, then we basically have to look at this, breaking this particular support level here, right? And again, let me put that Fibonacci retracement back up. Right, the way that I draw this Fibonacci retracement is really looking for, this little zigzag, right? So, if you see what I mean, okay. Let me go explain. All right. See this thing come up, right? And assuming, if it turned out that this to be a 100% point, right, then I'm looking for a retracement. Either come back down to the 78.6 or the 61.8, or these retracement zone level, right? Then it come back and then it bounces, right? Then it break above that 100. That's basically it's this pattern that we're looking for. So we're essentially giving you a higher high and a higher low, right? Come down here, right? And that's basically what we're looking at. Right? Now there are people, drawing some other Fibonacci retracement, right? They basically just go like this and say, okay, yeah, here's a 100, here's 50, here's 38, here's 618. It's break out and it's going to go, right? That's fine and dandy. If that worked for you, that's great, right? But to me, I look at these, retracement, finding support, and then breaking out resistance, right? So there's a lot of way to apply these, and that's the way that I apply it. So I always look for some retracement. That's why I don't, I don't draw it down here, for example. If I move this Fibonacci retracement down here, because if I draw it down here, then I say, okay, now it's terminated, which is target 127, because it came back and pulled back in under this 100%, this break point. Right? So now we got to look for a new pattern, right? The new retracement, the new swing point. Well, you can't look for a swing point if it's the same point as this point here, because then you have, what do you got? You can't go and say, oh yeah, if we chase 100% and then come back up, right? So that's not a retracement in my mind for the way that I'm going to use the Fibonacci retracement. So that's why you see, I kind of, adjust my Fibonacci once in a while when these pivot point get changed. Right? And you can probably see that from other technicians as well that use the Fibonacci retracement. Right? I mean, that's one way to do it. Not saying that's the only way, but this is the way that I use it. Okay, because I want to see, these kind of pattern, right? Come up to some resistance, come back, find some support, and then break that previous resistance. And that's why I'm going to use it. And then I'm going to use the Fibonacci retracement, to get me to the next level of possible resistance, right? Okay, so for example, in this S&P 500, if we do, find that this guy finds a support down here at this 1775, and then start coming back and then break out to a new high, then the next level I'm looking at is potentially be a 1902 somewhere, right? Okay, so basically that's what I'm looking at, and that's how I, use the fib. And also the other thing is sometimes I also look at confluence, right? Because we basically want to see what are the other market participants looking at, because there's all kind of different trader out there looking at different stuff. So one of the things is, for example, we're looking at this, trend line here, right? So if we draw a trend line up here and connect as many points as you want to, but at least more than 2 points. Okay, so I'm trying to connect to these points, and usually what I want to do is I want to connect to the close, right? And usually the closest to the last close would be, the better it is, because that's where you get these lot of the short-term support level that people found that support. So ideally, I would like to have this line connect to these 2 points and possibly a few more points here. But in this case, I got a little bit of a penetration down here, and also notice that there's a doji here. Right? I mean a little hammer here. So yeah, see this doji hammer. Okay. So if you want to do that, we could go back and do a little bit more. Let's say I connect these points here, and then maybe down here at this close here, Okay, so you could see that there could be a possibility of coming down, break below the 1775, 17, 1771, 72, that area, and come down and test this trend line, and then get a bounce, right? Because if come down and it spook a lot of the people, it could come down to this 50% point, which is somewhere around 1750. Right? You see this Fibonacci 1752, and sometimes I sort of round these number up because the starting and the end point of this Fibonacci is not exact. So you got this rounding area unless I go in and then tweak it. So that's why, for all intended purpose, the round number would be good enough because we're just looking at the ballpark vicinity of what we should be paying attention to, and then you could close in on it as the price get near to those level. Okay. So, and that's basically what I'm looking at on the S&P 500 next week. We might get a little bit of a consolidation here. Right? Hopefully, get another spook and then shake it one more time and then start bouncing back up. And then we might see it first level of resistance, maybe about this 1807, right? Or possibly get up to this particular pivot low here. All right, so that would be about 1819 level. Then we'll take it from there because you got these moving average, and a lot of these people looking at this moving average as a resistance. So by the time this price come up here to this 78.6 retracement level, the moving average probably be coming down and tag this, 78.6 level. So you could see a lot of people be talking about this 50-day moving average and that kind of stuff, getting that as a resistance. The green line is 50-day moving average, by the way, and the blue one is the 20 EMA, and the red one here is the 200-day moving average. So, okay, so let's go and take a look at the Dow 30. You can see the Dow 30. Let me take this out. Once again, it came down here. It seems like you found some support right at these levels, this pivot here. You see it kind of bounces back up, right? At this level here. Okay. So somewhere around this 15,000, what's that? 15,675 area, right? Okay. So again, if it could bounce up next week, get a little bounce, then we probably get it up to this pivot here, somewhere around this 16,100, and then this next point of resistance most likely would be this pivot low at 16,250 somewhere. And if we go back and we'll put in a Fibonacci retracement, okay, so you can see, let me take this line out here, you can see that it came down to this close to this 50% retracement and finding support. If it break through, here's that 200-day moving average. Look where it's sitting right now. It's at 38.2. So a lot of people was talking about, hey, the 200-day moving average could give us a support. Well, that might be the case. Remember when we talk about moving average, it doesn't give you support or resistance. You have to look at that in context, right? Yeah, and the context here is, this Fibonacci 38.2. Okay, so, but hey, the more different thing that causes, intersect at the one particular point, then we have a lot more confluence and just make that particular point, that price point have more technical significance, so we could see more people reacting at that particular price level, which is good, right? So kind of keep an eye on this, that the 200-day moving average, you probably hear people talk about that because most of the people don't talk about the Fib retracement. Most of the people could, identify with these 50-day and 200-day moving average because a little bit more simpler for these people to describe, these talking heads to describe to people. And then, we look at this, 50% retracement here. If it come back up, yeah, we'll probably, come and tag this, these level here, this pivot level, and it's close to this 50-day moving average. So a lot of these things, it seems like, it's coincident, right? It seems to happen at a certain level, certain things that causes and that kind of stuff, right? So that's why, hey, take it what it's worth on technical analysis. Same thing with the fundamental analysis. Who say 13 PE ratio is too high or too low? Talk about that. Go and talk about what the PE ratio is for Amazon and Netflix, right? Tell me about it's too high or too low or Twitter. So don't tell me about PE ratio, standard ratio, what is it, S&P, what is it pricing too high or too low and that kind of stuff. The same thing with technical analysis. Whatever work for you, okay? Right. So don't tie in on just one particular technique or one particular point. Have an open mind. Okay, looking at this Dow Jones Transportation here, I still think something is happening on that particular day. When the airline, everybody sold off, you know, that somebody blew up here or something blew up. I don't know what it is yet. Eventually, it's going to come out because we can't have drops like that on the transportation on a single day, and without following through, coming to, maybe selling off all the way down here like some kind of flash crash or something. So something happened here. Some fund or somebody have to something have to liquidate that they have to get out, and or they got caught on the wrong side on some bet on some of the transportation stuff or something. So, but in any case, so looking at the transportation again, we got this trend line coming up, and the support maybe is somewhere around down at this 7,000 level. Also, I got this Fibonacci retracement here. Once again, if we look at that, right, the retracement, okay, if it come down to the 618, break this resistance and go up, you know, or, right, or it could come up, right, come down here, encounter resistance, break down, you know, right. So that's how we play these potential Fibonacci retracement level to identify where the possibility of finding resistance and support. Right? That's why we have to have these little. That's why I look for these zigzag possibility, not just go and draw these V-shaped stuff. So anyway, that's on the transportation. Again, if it's going to move up, we see, it's sitting right at this 50 level. I mean, 50-day moving average resistance now, but it's really actually bumping up at this 78.6, level here on the fib. So if we're going to go up, most likely we'll probably see some more, encounter some resistance up here at this pivot high, which is also near the intraday low here. So that's one possibility, so you got these 74.5, and then you got this pivot low here, 74.32. And by the way, a lot of time, I also, instead of using candlestick, I just go and use the closing price, right? Then you can see some of these pivot a little bit easier, you can see right here, right? Now we could easily see and identify these pivot point, right? Okay, so you can see that the possibility of, a potential resistance. Okay. Although, yeah, the candlestick kind of look interesting. If you're looking at the formation, the type of candle, and interpret the price action within that candle, then it does give you a lot of information. For example, if you look at this candle like a shooting star doji, it's going to tell you some of the, buying, sort of exhausted. So you kind of anticipate some pullback, right? And then when you see some of these, long shadow hammer, right? You could tell that, maybe a lot of the selling is exhausted, right? Then you could see a little bounce. Okay. So, but then there's other thing. It's like these combination of candle. If you look at this is actually, if you add them together, right, and make that 2-day into 1-day candle, into one candle, you can see this is a, like a little hammer here. Okay, so that's why you could, these what they call a tweezer type of bottom, right? You know, uh, could give a bullish implication here. So you can see the reason why is because if we, go and trace these out, what you essentially end up with is a candle pattern of, this sort here. Oops, let me do this. Right? It's basically, you can see that it's end up, a matter of fact, since this closing price is higher than the opening on the previous day, so you actually end up with a green, a hammer. Okay, so, but go and take a look at some of those patterns, and it's revealing if you see some of these price action and look at the chart the way that it's intended to. There are a lot of clues in there because we're basically looking at the human greed and fear that is being imposed to form those candles. Okay? Okay, let's take a look at NASDAQ. I know I'm blabbing on a lot on this video here, but I just want to get some point across so you guys don't get sucked in on, taking a lot of these things for granted and think, it is what it is. It is not what it is. It's just, opinion of a certain person or certain group of individual. It doesn't mean it is what it is. Uh, you, it is what you make it to be. Right? It's when you put money on the line and place a bet. Okay, so the Nasdaq got this little trend line. It's moving, still sort of bouncing off this trend line here and bumping up against this resistance here at the 50-day. If it continue to bounce up, we anticipate that thing to probably come back up at least this 36.93, 36.94 area, and possibly take out. Maybe it's too early for us to talk about taking out the previous high. Okay, but certainly, it came down. It's got away from the moving average a little bit, so you got this little, reversion to the mean. So it came back down, and now it's coming back this trend line here. So it could be doing a little consolidation and get a next leg up. So we kind of keep an eye on that. Yeah, there's a lot of people talking about these financial crises on the, emerging market and that kind of stuff. We deal with it when it blow up, but for now we trade based on the price. Okay. And then here's the Russell 2000. See again, you can see the Russell is kind of still coming bouncing off of this trend line here, and bumping against this 50-day. But also you look at this, these level here as a potential, this right here as a potential resistance, right? You know, so so it's basically where we are right now. And if we could get to that, then we probably could make it back up to possibly up to this level here, maybe somewhere around 1164, and then see what come of it, and maybe we'll take out the previous high. So for now, that's basically the market. And if you have any question or any comment, either tweet me or go to my blog and click on that contact page and then send me the email. One thing I cannot give you and will not give you is trading advice. But if you have some idea that you want to discuss, I'd be more than happy to join in to discuss with you on idea if it's relevant. And if you got question, just send me the question on some of the stuff that I rambling on or whatever, or you might have seen something from somewhere else. And if it's appropriate for me to address that, I will address it accordingly. If it's inappropriate for me to answer, then I will politely let you know that, can't answer it. Okay? So have a nice weekend.